5 questions 50% CFA Level 1 candidates fail to grasp. Conceptual overview. CFA Level 1. Question 5. A financial analyst is reviewing the annual report of K9 Dynamics, a company that designs robotic pets. The report provides a highly detailed and transparent breakdown of a significant non-recurring gain from the sale of a patent, which accounted for nearly all of the company's profit for the year. The core business of selling robotic pets operated at a small loss. The report's disclosures are clear, complete, and conform to GAAP. Based on this information, the analyst would most likely conclude that K9 Dynamics has a low earnings quality and low financial reporting quality, B, high earnings quality and high financial reporting quality, C, low earnings quality and high financial reporting quality. Correct answer, C. Earnings quality is low. The company's profit for the year mainly comes from a one-time sale of a patent. These one-time gains aren't going to keep coming, and they don't really show how well the company's main business is doing. The main business, which is selling robotic pets, isn't making a profit, meaning the main operations aren't bringing in money. So the earnings don't give us a good idea of what's going to happen next, which makes them low quality. The financial report provides a detailed and transparent breakdown of the non-recurring gain. The disclosures are clear, complete, and conform to GAAP standards. High financial reporting quality means the information is accurate, transparent, and adheres to accounting principles. The transparency and completeness of the disclosures indicate high financial reporting quality. A, incorrect. Low earnings quality is correctly identified, but financial reporting quality is misrepresented as low. B, incorrect. Earnings quality is misrepresented as high due to non-recurring gains, not sustainable core business profitability. Question 4. A company's financial reports are found to be biased and contain several material omissions. The most direct and likely consequence of this low financial reporting quality is that it A, causes the company's cost of capital to decrease. B, makes it difficult to determine if the company's earnings are sustainable. C, guarantees that the company's earnings are of low quality. Correct answer, B. When financial reporting isn't up to par, the financial statements can be skewed or missing important details. This can make the information we get unreliable, incomplete, or even misleading. Because of this, analysts and investors have a tough time figuring out if the earnings reported are coming from solid, ongoing business activities, or core operations, or from just one-off events or tricks. The biggest problem is that we're left with a lot of uncertainty about whether those earnings will keep coming in the future, since the real economic picture is hidden. A, incorrect. Low financial reporting quality increases perceived risk, leading to higher investor returns and increased cost of capital, contradicting the options claim. C, incorrect. Low financial reporting quality doesn't necessarily indicate low earnings quality, as high-quality earnings can be obscured by poor reporting. Question 3. An analyst is attempting to determine if a company's strong reported earnings are sustainable. The analyst discovers that the company's financial reports contain numerous opaque disclosures and make use of accounting estimates that appear to significantly overstate assets. For the analyst to form a reliable conclusion about earnings sustainability, which of the following is the most critical prerequisite? A, the underlying earnings must be of high quality. B, the financial reports must be of high quality. C, the company must have a high return on investment. Correct answer, B. To really get a good sense of whether earnings will keep coming in, the analyst needs solid and clear info. Great financial reports give us the real deal, accurate, full, and fair data. That shows what's really happening with the company's economy. If we don't have those good reports, it's tough to tell if the earnings are going to stick around, or if they're just a fluke, or if the company is playing games with numbers. So getting those high-quality financial reports is super important if we want to make a solid call about whether earnings are going to be sustainable. A, incorrect. Analyst aims to determine earnings quality and sustainability, not assume it beforehand. C. Incorrect. High return on investment doesn't guarantee reliable financial information, which is crucial for assessing earnings sustainability. Question 2. An analyst concludes that a company's earnings are of low quality. This conclusion is most directly supported by evidence that the company's profits are primarily generated by opaque financial disclosures that obscure the source of revenues, B. A one-time sale of a corporate asset that will not be repeated, C. Aggressive revenue recognition policies that violate GAAP. Correct answer, B. Earnings quality looks at whether the company's profits are coming from solid, ongoing business activities. Financial reporting quality checks how well and clearly the company shares its financial details. A one-time asset sale is clearly not something the company can keep doing regularly and sustainably. The profits don't show what the company can earn from its regular business. Low earnings quality is characterized by a lack of sustainability, even with perfect transparency and GAAP compliance. A. Incorrect. Opaque disclosures hinder the assessment of earnings quality, which is distinct from reporting quality. While low reporting quality obscures information, low earnings quality indicates unsustainable economic results. C. Incorrect. GAAP violations are extreme reporting quality problems, distorting information and crossing into fraud or misrepresentation territory. Question 1. An analyst is comparing a company's earnings quality from one year to the next. Which of the following scenarios would most likely indicate a decrease in earnings quality for the current year? A. Earnings increase due to higher sales volume from the company's core product line. B. Earnings remain stable, but a significant portion was derived from a one-time legal settlement. C. Earnings decreased because the company increased its research and development spending. Correct answer, B. Earnings quality is all about how well the money you make from your main business stays around for a long time. Good earnings are like a steady stream, coming from things you do all the time. But if your earnings come from one-off events or things that can't last, they're not so good. Think of a one-time legal settlement, option B, as a one-time windfall that doesn't show what your company can really do to make money from its usual work. If you include these kinds of gains in your earnings, it makes them look better for a little while. But it doesn't really mean your company is doing well in the long run. That's a sign that your earnings quality isn't as strong as it could be. A. Incorrect. Earnings from core operations are sustainable and high quality. C. Incorrect. Reduced current earnings reflect investment in future growth, enhancing long-term earnings quality. High-quality earnings come from core operations, while low-quality earnings rely on one-time events or accounting manipulations. Analysts must adjust for non-recurring items to assess true earnings sustainability.